Thanks for
Okay.
joining us today. My name is Lauren Wells. This is Chris Seveney.
Hey everyone.
Just started here. I'm just going to go over housekeeping really quick. If you have any questions, like I mentioned, please feel free to drop them in the Q&A as we go along. We try to answer as many as we go, and if not, we'll answer the remainder at the end. So again, Q&A box, not the chat box. Feel free to drop them in there, and I'll be monitoring that. And with that, Chris, I will let you go ahead and get started.
Yep. Thank you, Lauren. And today we're going to talk about mortgage notes in this economic climate. It's a question that we get asked frequently, not only to our investor relations team, but to Lauren, myself. It's probably one of most asked questions, and we wanted to talk today about that specific topic. Before we dive deep into that, we will talk a little bit about who we are, our backstory, a little bit more on the industry, and also at the end provide some case studies as well. So who we are, Seveney operates under CWS Investments. As Lauren likes to say, we fix and flip mortgage notes. We do this with our in-house team that we'll talk about more. And we primarily focus, as we mentioned, on those non-performing assets, as well as having performing assets within our portfolio as well. Overall experience, I've been in real estate for 25 plus years. We'll talk more about our story later. But again, we have an in-house team of that 7 to 8 people operating our fund. And Lauren,
So,
I'll let you
oh, go
go
ahead.
first on backstory.
Okay. So that's a little bit about who we are, but I think really it's important to understand where we come from and kind of how this offering and Seveney and this asset, how we got here. And Chris and I both have similar but different backstories. So I wanted to talk a little bit about that, and I'll go ahead and start with mine. So I like to say I was a college graduate turned corporate junkie turned real estate investor. And so really what happened, I did what most people my age do. I am a millennial. Went to university, got a degree, and actually started working for software companies based in my area in software sales. At that same time, I was also volunteer coaching for a high school water polo team. I played in college, and so it was really fun to be able to give back in that capacity to a local high school. So while I was doing that and working, what I realized was a lot of people that were in the stands, a lot of parents that were showing up to games, practices, all the things, either own their own business or invested in real estate or both. So it was at that point that, I was newly married, but I did know I wanted kids at some point, that I decided that I was going to use my sales commission to start investing in real estate. And by that, I don't mean like directly investing. At first, it was a lot of doing what you're doing right now, attending webinars, meeting with networking, going to real estate investment clubs, and really learning about all the different ways to invest. Passive investing was kind of, and still is, the hot term. So what does that look like? How could I do that? I had seen people do invest in fix and flip, Airbnb, wholesaling, all the things. But really, I'm a little bit of a control freak. But so I heard about mortgage notes, actually. Someone was speaking about it. And I really liked this idea of not having to deal with tenants and becoming the bank. So essentially, you become the landlord, not the landlord. So from there, I actually started growing a portfolio of mortgage notes. I had a mentor that I had reached out to, worked for him for free to learn and grow my own portfolio. At which point I was, still attending conferences more specific to mortgage notes at this time, where I met Chris, who spoke about investing in first position liens and all the money you would lose and how you could lose money. So naturally, I was like, I want to know all the ways this could go wrong. I'm still learning. And I started actually investing in second positions at the time because it was a lower cost of entry and I could diversify. So making that transition at first, I started working with Chris, and we've managed over 600 deals and had 5 funds go full cycle. And while we were doing this, what we really realized was that there were a lot of people who were basically a former me, a former Chris, who didn't have access to these type of investments where you're truly investing passively. You're not having to manage a rental. You're not doing renovations. You're not worried about, if rates go up and down or having to flip it in a certain timeline. True passive, here I'm doing my due diligence on a sponsor, such as Chris and myself, and I'm expecting XYZ returns. And that's really where the Reg A came from, really giving everyone the availability and accessibility to invest in something without having to throw in 25, 50, $100,000 like most offerings, and not having to have that accreditation status. So that's really where the Reg A came from and why it is unique. And that's a little bit about my backstory and how we got here. And so now I'll let you, Chris, go and talk about your kind of story.
Yeah, I'm somewhat the opposite of from when Lauren comes from. We both had the W-2 jobs. I have always been in real estate. I'm an engineer by trade, so I've always been a numbers person. I spent 15 years building buildings as a project manager and building a lot of cool buildings. And then when I went over to development side, the senior VP at the time looked at me and he's like, "What do you have for your own personal portfolio?" And I said, "Well, I got my 401k and so forth." And he looked at me and he laughed and he's like, "Yeah, you don't plan on retiring anytime soon or ever." And first time I ever heard him call the 40-40-40 rule, which is you work 40 hours a week for 40 years to collect 40% of your income. So that caused me to really start kickstarting my personal investment career, which started out like most people, buying rentals. And my wife and I were buying rentals and we were fixing them up and doing, that BRRRR strategy of refinancing them, getting our money back, and rinse and repeat. But I am also a father and at the time had 2 young kids, and trying to do that while working and being a parent was nearly impossible. Plus, again, like Lauren mentioned, dealing with the toilets, the termites, the tenants, getting a call on a Sunday when you're trying to relax and something happens, it got old pretty quickly, and looked to pivot. And that's when now it's been 8+ years ago, I discovered there was mortgage notes. And I had always known there was private lending, but did not realize there was this whole world of buying assets on the secondary market. So I started buying notes on my own. And then as that grew, started having people reach out and say, "Hey, can I invest in a deal?" And that continued to grow to our funds. And to this day, with the Reg A, like Lauren mentioned, we had a lot of people out there who were both not only accredited but non-accredited that were really interested in this type of institutional investment or asset class, but they weren't allowed to. All the other funds had $100,000, $250,000 minimums, and you have to be accredited. And we wanted to provide this opportunity to everybody. Lauren, I'll let you talk about the mission.
Yeah, so really kind of from that, and we just kind of both said it, our mission is really to, and is a cliche saying, and it's probably cliche because everyone knows what it means, is to really democratize investment opportunities to the masses while providing win-win solutions to borrowers. So what do we mean by that? Really, again, it comes back to making investments accessible and available. So available in that the Reg A, you don't have to be accredited, anyone can play, anyone can get involved, and then accessible in that it's not a big commit. There's a low barrier to entry. We're not saying with most funds, you have to have 25, 50, 100K to get started. Because I remember me sitting where you are thinking, okay, even if I have the 50K, that's a lot to invest in a first time investment with one person. I want to get to know these people. I want to get to know how they communicate. I want to see like some, proof before I really double down. So again, making it available and accessible, and then allowing us to provide those win-win solutions for borrowers and our investors. And we'll talk about that and how we do that here shortly.
So we'll talk briefly about the industry as a whole. And I don't think a lot of people realize the actual size of the mortgage note space, which it's over $13 trillion. And one of the questions we always ask is, well, are there enough non-performing loans out there? And, with 80+ million single family mortgages out there at default rates of 1.5% to 2.5%, now that's still over 200 billion in non-performing loans, which would equate to about 1.5 million homes. And just as an example, we just finished some statistics from Q2 of this past year. We had over $800 million in non-performing loans come across our desk. So to give you an idea, just the size of the market overall. And you want to take this one, Lauren?
So mortgage note investing, we kind of talk about it at a high level, but what really is it? So it's an investment strategy secured by physical real estate, in our case, single family homes. So note investors were buying loans from private lenders, banks, home loan traders, hedge funds, or brokers. And what we're doing is we're purchasing these notes, these loans at a discount, and we'll talk about why here in a second. And then what happens is we become the lender of record. So I don't know if anyone listening today has ever purchased a home and they have a loan, and within a few months, usually it's about 90 days, they get a letter, and it might be longer, but typically we got our first one when I purchased my first home. It was about 90 days later, I got a letter in the mail that said, hey, Chase Bank has sold your loan to Citibank. Citibank is now your new lender of record, and all payments are to be sent there. That's the sale of a loan from one lender to another. That's what note investors do. They become the lender of record. They're the ones sending out those letters. That's what Seveney does. So, fun fact, if a loan was held for about 30 years, which most loans aren't, people refinance, they move, but if a loan, it would be sold an average of 7 times. So this isn't something that, happens every once in a while. Banks, credit unions, funds are selling and buying loans on a consistent basis. And again, we'll talk about why in a little bit. So as the lender, as the note holder, what you're doing is you're purchasing the rights to the borrower's future mortgage payments. So you're the one collecting those principal and interest payments and the right to repayment according to their note. So,
yeah, and one thing I just want to add to that is, as the bank, we step in the shoes of the bank. We don't own the property. I think that's one thing a lot of people sometimes struggle with, thinking that, oh, you're buying the property. No, we're just the lender. So if a toilet breaks, if your toilet breaks, I'm assuming you don't call your lender. Same thing, if our borrower's toilet breaks, we don't get that phone call. We just deal on the payment side.
yeah. However, it is secured by the home. So there is a
Yes,
difference. Being
correct.
secured by the home means that, say it was the lender or the borrower decides, I'm not going to pay. And that, therefore, just as a bank, the lenders have rights to go through the foreclosure process, at which point they could take back the property. That is very rare. But again, you do have the right to repayment via the security of the property.
Yeah.
So,
and we'll talk a little bit. We've done other videos about what a note versus a mortgage is. That really delineates the note is the IOU, the mortgage is that security that allows you to go after the property if they fail. So 2 types of loans that we look to acquire are performing and non-performing. So what is a performing loan versus a non-performing loan? Performing loans are when a borrower is meeting those repayment obligations and making their on-time payments. These can be purchased at a discount, which we can talk about some examples later, but really based off of the interest rate. So the other type is, again, the non-performing, which is when a borrower hasn't failed to meet their repayment obligations. And the repayment obligations could be their payment. It could be taxes if it's not escrowed. It could be not having insurance. Those are all things that we monitor. And non-performing loans typically do get purchased at a steeper discount, because they are in some type of distress from that perspective. Now, most people think, I'm not 30 days behind, I'm 60 days behind. Oh my God, they're going to come throw me out of my house and foreclose. Banks typically do not like to deal with defaulted debt or foreclose. And loans that we acquire typically on average are 2 to 3 years behind on payments. Not months, but actually years, to give people an idea. And I will let Lauren talk about how we make money in notes, because she's got this down to a T.
And this will be the one time I mess it up, watch. So like Chris mentioned on the first slide, what we like to say is we fix and flip mortgage notes. And we use this comparison because for 2 reasons. Most people are familiar with the concept of fixing and flipping a home. They maybe have watched a HGTV show or 20 about this. So it's something that people can understand, and we apply it to our strategy because it is truly very similar. So really, that first step is buying loans on single family homes at a discount. So that's the purchase, similar to buying a house that you think you're going to fix and then flip. So we're buying these at a discount because typically they are in distress, meaning they're non-performing, borrowers haven't paid for at least 90 days. And from there, it really can go two avenues. And this is the fix process. So the most common for us, about 90-95% of our portfolio, is really the top route, and that's negotiating payment schedules with the borrower. So what we're doing is we're working with these borrowers to come to some sort of agreement. Now, I think it's important to understand that these borrowers don't just wake up, and a lot of due diligence on our side goes into evaluating the borrower's ability to repay and desire to get back on track. So, these are pre-vetted, I guess you could say, borrowers, in that we've looked at what really caused them to fall behind. And we do address this later, but I'm going to bring it up here as well. Typically, people don't wake up one day and say, I'm going to stop paying my mortgage. If anyone was like me, or thought if you don't pay your mortgage, the bank is going to take your home and, the next month. While that might not be the case, most people don't pay because of some life event, divorce, death, health, job loss, something that caused them to stop paying. They go back to the bank. Banks are notoriously inflexible, also hard to get on the phone and work with. And so when we have purchased the loan, we're purchasing at a discount. So we have the ability to be more flexible, work with the borrower on their past due. And so I'll kind of walk through an example here. Someone's $30,000 past due. They can still make their monthly, but when they went to the bank before we had purchased the loan, the bank was like, that's great, you can make your monthly, but we're going to apply that to your past due and your late fees. There was really no way that person was ever going to get caught up. So what we do is we put most borrowers on a trial payment plan. They commit to making monthly payments for 6 months, their normal monthly payments. At the end of 6 months, we will modify the loan. We will either recast it, meaning we will extend the term, so adding those arrears to the end, arrears meaning past due balance, and then, or they can make monthly or quarterly payments towards their past due. So again, we're increasing the value, we're fixing the loan by increasing the value, by getting that borrower performing again. We hold it and season it to make sure that they're consistently paying for anywhere from another 6 to 12 months, at which point we will sell it as a performing asset for a higher margin, or the borrower will refinance or sell the property, at which point we are paid off in full. Now, something important to understand is if we're purchasing that loan, say that loan is a $250,000 loan, we're buying it for $200,000. The bank still has rights to collect on the full 250. Regardless of what we paid for it, you are still owed the full 250. So I think that's important. We're not buying it for 200 and only owed 200. So that's really what gives us that flexibility to work with the borrowers. The lower route is really when people decide that, and again, this is about 5% of our portfolio, where the borrower decides they're not going to work with us for whatever reason, or it's a deceased borrower. At that point, we will continue with the foreclosure process and it generate profits from the sale. Now, most people will ask, well, do you take back the property? We are not in the business of taking back properties. Typically, when these do go to foreclosure sale, as you can imagine right now, investors will show up and pay nothing for a house that is worth a lot more. So they typically get sold at auction and we get paid off the full amount of the loan, plus any legal fees that we've recovered are recoverable during the foreclosure process. So again, just giving you an example of that fix and flip process that we employ here at Seveney.
One thing I'll add is when we're going through that trial payment plan and modification process, we're heavily involved in understanding a lot of the financials behind the borrower and what does and does not work. And I think that's another thing, like Lauren mentioned, banks are flexible. We can be very flexible and making sure it works for us, but also works for the borrower and creates that win-win situation that we talked about prior. And we can get it done in a very timely occurrence of, we're talking hours to days, where we'll talk more about case studies where with banks, it's like years. So now we're going to talk about the current economic climate because it is a question we get asked a lot. And we'll talk a little bit about the asset class in this environment. That Lauren, do you want to talk about this one?
Yeah. So the asset class in this current environment, essentially, we actually know you talk about this and we have another slide looking
Okay,
at the
no problem.
2008.
Yeah. So right now, you probably see a lot of articles about private credit, which is, mortgage note investing is a type of private credit investment. There's a lot of other funds starting private credit funds. There's also, uh, you know, big BlackRock and others also creating private credit, and it's preferred because of the rising interest rate, this interest rate environment, and with it, we have these higher rates because of inflation, and what this has caused is a lot of people who are in that housing market or multifamily. There's that lack of inventory. And what's going on today, and I think we're finally starting to see it when we look at a lot of the data that's out there, is the inflated rents, inflated insurance, inflated taxes, just everything right now is a lot more expensive. And borrowers are having a lot more difficulty in regards to paying their mortgages. We also have banks on the other end focused on liquidity. And the way the banking system works is banks love performing loans. Banks hate non-performing loans because of how they have to classify them on their books. And it's like the hot potato. When they get it, they want to try and get rid of it as fast as possible. So we're starting to see an increase in non-performing loans and banks looking to sell, which makes economic times when things start to soften a great asset class for mortgage notes. So anything else you want to add, Lauren, to that?
No, I think you covered it.
And I know
For
we
this
also
slide.
get asked a lot about, well, 2008, everything went bad and so forth. So Lauren, why don't you talk
Yeah.
about a lot of differences?
Yeah, so this comes up quite a bit. Well, how's this different from 2008? I remember, hearing about that, and really it's a very different situation. In 2008, that was really lender induced. Those were loans that were written to probably people that probably should not have had those loans, weren't qualified. Um, so in 2008, you had your housing bubble that bad lending practices led to inflated home prices. Borrowers were over leveraged, so the house was not, the loan was bigger than the value of their home. Um, and what happened was borrowers were able to walk away from their property, find a place down the street to rent. And yeah, they may have had a bankruptcy on their, on their
Record credit.
record. I was gonna say resume. I was like, that's not the right word. On their record, but they could walk away and they easily found some place to rent, probably just as nice of a house down the street. Today, that's not necessarily the case. So they had no incentive essentially back then to get on track, repay their mortgage. Today, home prices are increasing, but this is caused by demand. There is a housing shortage. It's not caused by the excess lending. Borrowers have significant equity in their homes and rental rates are through the roof. So borrowers are more incentivized by default to work with us because they'll look around. Not only do they have an emotional equity in the property, but if they look around, and they have a 3 bedroom, 2 bath, and say their mortgage is $3,000, they can look down the street and see what they can rent for $3,000, and it's probably a 2-1, and it might be a condo. So they're looking at, okay, is there a way for me to work with the lender to come to the table to figure out some terms that make sense? Because one, if they can find a place to rent, again, inventory is super limited, and then rental rates are through the roof. So they're highly more incentivized. They're not just going to walk away from their property. Um, so it really isn't the same as 2008. So
And also just add, we're not anticipating another 2008. That was, again, something, like you mentioned, extremely induced by over leverage,
yeah.
bad regulation, and with everything that's in place now, could there be housing softening? Of course, but I don't think anyone's predicting something like a 2008. But
So this is, I'll let you talk about this, but so this
Okay.
is really when we talk about equity in the home and like what is something that's really important to us when we are investing in these loans. And this kind of is an example that walks through what that looks like and the coverage that we have should housing prices drop, because that is always something that comes up. What happens if 2008 does happen and housing prices get cut in half? They didn't then, but let's just be super dramatic about it and say that does happen. So go ahead, Chris.
Yeah. So here's an example of, we'll take this home that's worth $250,000 today, and they have a $100,000 loan balance. And one of the things we like to target is loans that are 8, 10, 12 years old. So it allows us to get in this situation. We typically are not buying homes that were newly originated or originated a year ago, that the borrower may only have 10% down because of the risk involved. So these loans, again, think about if you had a house for 10 years that it's now worth 250, you owe $100,000. So even if there's some softening, there's still, you're not going to lose that equity. But if the borrower gets behind, and we go to look and buy that note and we acquire it at 50 cents on the dollar, then we're paying $50,000 for that loan. And when you look at the investment to value of, okay, we put $50,000 out the door, we're still owed 100 on that $250,000 asset, that investment to value is only 20%. So the borrower has equity up through it dropping by 60%, I think, and then 80% drop before our investment would get touched. And there's a question that somebody asked about.
I was
Um,
just going to say, I think this ties in really well to the question that I tried to explain earlier about what the bank is owed versus what they purchased the loan for. So, Chris, I'll let you answer, but I just want to add something kind of context to that. So, when loans are sold, they're sold at a discount, whether it's performing on someone's paying on time as is expected or non-performing. Now, regardless of what the buyer buys the loan for, the loan balance, outstanding balance owed to the bank does not change.
yeah.
So,
So yeah, I'll just use, let's say, I'm just going to use you as an example, Lauren.
yeah.
I have $100,000 loan on your $250,000 property, and unfortunately, you get behind on payments, and I get that loan and I buy that loan. Me buying it for 50,000, you are completely outside of that transaction. So Wells Fargo and myself strike a deal. Wells Fargo doesn't want to deal with Lauren. They're like, please I'll sell this to you for $50,000 because I don't want to deal with Lauren. We buy that. What we're buying is, again, a loan secured by that property that Lauren owes us $100,000. So whether we pay more or less for it, no matter what, Lauren owes us that 100,000. And if she doesn't, you hear the term foreclosure, which is a legal process that we can use to sell the house to collect those funds. So if there's equity in the property, term typically one way or the other, you're either go after the property to get the money or get it through that borrower. So we have two areas of recourse. And the other question is about investing and holding title. The way I'll use the term hold title to these assets is when you buy a mortgage, it's called an assignment. So the loan gets assigned to us, that gets recorded in the county. So it's on title that borrower, if they were to go refinance, that whoever refinances them would see, oh, you owe this person as a loan, so they would contact us to get it paid off, or they can't sell the house and issue clear title without us getting paid off.
Yeah, so we would become the lender of record, record being it's recorded.
Yep.
And yeah, so sellers, why do banks sell? We get this question a lot. Actually, all these questions we do, or we wouldn't have them in this slide. So I'll stop saying that. Excuse me. So really two reasons. Banks want to get well, let me back up. Banks are very good at creating debt. We all know this. They're very bad at managing debt. If anyone has ever tried to call their bank about anything like the issue they need resolved, you can understand it's probably a really hard process first to get through the automation, and then to speak with an actual person, and then to get someone who can actually help you. So imagine that process with lenders who aren't paying. You know, banks are not good at managing debt. They're very good at creating it. So when banks have non-performing notes on their books, they can look at it like this. Okay, if we're not good at managing debt, so it'll take us anywhere from 18, 24, 36 months, probably more, to go through that foreclosure process. And or we can sell it at a loss, so at a discount, and use that money to rewrite a new good loan at a current interest rate. So they're gonna lose in the short, but they're gonna be making more money immediately after because they're gonna be able to create more debt. And then when it comes to performing loans, we have a lot of loans that are great loans. People are paying on time. You know, me, for example, my interest rate is 3%. The bank is essentially losing money on my loan because interest rates now are 7%. So they'll sell performing loans in order to, again, even at a, it's not as significant of a discount, but they're going to sell that for a loss to be able to, again, write paper, a new loan. When I say paper, I mean a new loan at 7%. So two reasons. They also look to rebalance their portfolio. If it's a fund, that fund might be closing. You know, we sell loans as they become performing. They might want excess cash, so liquidity, or assets may not fit their buy box. So if we're talking about a fund, it may be a fund that only does seconds, so they will sell first, or they may only deal in certain states, and so they'll sell the loans in the states that they do not do business.
And perfect example of that is last year there was a pool we were buying of 20 plus assets, and there was one asset in Montana. And Montana is not a, have we bought there in the past? Long ago, but it's not a state we're active in. And there was an investor who was very interested in Montana notes. So we bought that pool and turned around and just sold that Montana asset to that individual, and we made money on the sale. And then they took it over because for us, it was just didn't fit our our buy box or what we wanted within our portfolio. So there's many reasons why people sell. It's not because it's an awful asset. I think a lot of people think, oh, they just want to sell it because it's not good. But actually, that's typically actually not the case. And as Lauren mentioned earlier, what causes the distress? We've already talked about this. People don't wake up one day and decide, oh, I'm going to stop paying. Typically, it's job loss, health, death, or divorce. And as part of our due diligence, we get to see, under the hood of what is going on with the borrower through the comments from the servicing company. We get, as part of due diligence, like a Bible. Not the Bible, I'm sorry. Oh man, I forgot the term that you're writing all your journal. All the notes that are in there about the history. So they record the conversations and it all gets transcribed into text that we can see what is going on. Diary was the term I was thinking, by the way. And then also why we don't typically foreclose is, we've mentioned this already, borrowers want to stay in their home and they're incentivized. They have that equity. They have, it's very challenging to find a place to go. If you have bad credit and all this equity and a lower mortgage payment than rent, you have zero interest. And then there's the emotional equity that people have been in their house 20 years. They've raised their kids there. So there's so much in regards to why people want to fight to stay in their home. And I'll let you talk about the interest rates, Lauren.
Yeah, so interest rates, how do interest rates affect what you guys do? If they go down, if they go up? So at Seveney, we're really interest rate agnostic because we're bidding on assets based on a targeted return. So example, if we need a 12% return, then it's a $100,000 loan and that interest rate is 8%, then we will bid 66,000. If it's a $100,000 loan at 4%, then we're gonna look to bid 33,000. Again, we are bidding based on a yield. We're not really bidding, so the interest rate is a factor in that, but regardless, it's not a direct indicator of what we're gonna like how we would be impacted. So anything else to add to that, Chris?
Yeah, and this will kind of add into answering the question of how do we determine our offer. Uh, there's the payment, the interest rate, the state that it's in, because his foreclosure timelines vary. So if you had the same note in Georgia and one in New York, that note in Georgia might be 75 cents on the dollar. The one in New York would be like 30 cents on the dollar, because in Georgia, it's a 4-month foreclosure timeline. In New York, it's a 4-year timeline. So you got to think of, the time plays a critical role in how we value our assets, along with other factors.
Yeah, and we don't talk about it a lot in this webinar, but we have a whole webinar on due diligence where we really walk through our due diligence process, because that is a big part of what we do, making sure that we are verifying all the seller data, all the note data. There's the value of the property, making sure that title is clean, making sure it's collectible, making sure it's within, state statute of limitations, making sure it's a first position lien, not a third position lien, our taxes outstanding. So we do have a whole webinar on our due diligence process, how we focus, what our buy box is. If that is something you're interested in, please feel free to reach out to invest@seveneyinvestments.com. We can send that, or you can head over to our website and it will be under the webinars, resources, and then there's a webinars tab you can click on, and you'll be able to see that past webinar on our due diligence process. So we didn't get into a lot of it here, but again, we do have that in depth, great detail on our website. Go ahead, Chris.
So why now? I think we've talked a little bit already about what we're seeing in the economic climate and what is going on. Defaults are on the rise. The New York Fed just came out with some statistics, or a chart showing mortgage defaults increasing, auto debt increasing, credit card debt increasing, and it's more of a hockey stick increase. So I think people can expect that to continue based off of what is going on right now. During COVID, defaults were extremely low for many instances. One, banks weren't allowed to go after borrowers. There were moratoriums in place. Plus, it was a very strong economic climate, and there was $7 trillion pumped into the economy that helped a lot of people stay afloat. Now, unfortunately, with that caused, or what many believe caused, inflation, and us heading to this slowdown where we're starting to see people take out lines of credit. They're defaulting on the lines of credit. We're starting to see an increase in the mortgage defaults. So we're starting to see this take shape. And when it does, it starts to increase the opportunity for us, increase inventory, which also can drive down some of the pricing that we pay on assets. So unlike a real estate market where there's a lot of, it's similar to real estate where it gets flooded, the market, some values come down. But for us, when that happens, it actually flips, because mortgage note investing can do better in times of distress, and gives more opportunity for us. Anything else you want to add, Lauren?
No, again, just simple kind of like supply and demand. As there's more inventory that hits the market, we're able to be more selective about the assets and get better pricing on the assets that we acquire. So naturally, like Chris said, in a downturn market, we're going to have a lot more opportunity. So Chris is going to talk about this case study, but it kind of ties into a question. So the question was about why banks don't work with a borrower. Do they just, once the bank, can't handle it, do they sell it off? So I think, oh, wait, do we not put that case study in here?
No, it's in here, but
Okay.
they're all, these case studies are all very similar in regards to that answer, that question. And I saw that, I'm like, oh, case studies.
Yeah. So I'll let you take it from there.
Yeah. So here was a non-performing loan that we purchased at approximately a 50 cents on the dollar, and the borrower also had about 50% equity. So it was a $600,000 home that borrower owed $300,000, and there was, say $150,000, with the purchase discount. it was non-performing. And to answer that question, the prior lender did minimal efforts with the borrower. I use the term Groundhog Day because what happens when a loan goes delinquent is the lender will typically send what's called a loss mitigation package, which is really a loan application along with what happened. So it's, please tell us why you're behind. Do you want to keep the house? What's your, how much you make, what's your earnings? Give me a bank statement, show me your bills, all of that information. And the bank in this specific instance had a 90-day timeline, meaning the data had to be within 90 days. So, but what happened is there were so many segments of this bank, by the time it made it from the first person to the last person, that 90 days had expired. So the last person would get it and say, I can't review this, it's more than 90 days old, go get a new package. And this happened multiple times. So that's why I use the term Groundhog Day, if you've seen the movie. So they just kept going, and then they decided, oh, we can't get anywhere with the borrower, so we're just going to sell the loan. And initially, our outreach was unsuccessful with the borrower. And this is very common because they're used to dealing with somebody else. So like, who are you? We don't know who you are. And like Lauren said, you get those letters that say your loan is sold. A lot of times those just get thrown in the trash. I know back in 2008 that happened with me. I remember because I was with Bank of America and then I got a letter from another bank. I'm like, I don't need a refinance. So I just threw it in, not realizing my loan had been sold. So the borrower was unresponsive, but when you send a demand letter from an attorney and it says law offices of, Lauren Wells Esquire, people jump. And this borrower became responsive. And of course, they wanted to stay in the house because you can see this is a well-maintained house that they had. So we signed the borrower up to that trial payment plan, which is, I like to say, it's kind of a payment plan on training wheels. It's, hey, let's make sure this works. And if it does, we'll modify the loan. And the borrower made, all of their payments as part of the trial payment plan. But we also, and this is where, again, difference between us and a bank. The borrower was, about $16,000 behind and said, hey, look, I can't make up $16,000 in the next 4 months, but I have a bonus coming at the end of February. Can I pay an extra $1,000 a month and then pay the $12,000 with my bonus? And we were like, yes, let's do that. And you do that, we'll reinstate, modify the loan to bring it back to current, which is what happened in this case. And then borrower did get their bonus, they paid us, and the loan is brought current. And now, like Lauren said, we do what's called seasoning. We want to make sure the borrower keeps paying, and then we'll turn around and liquidate that back on the market as a performing loan later on, and it will not sell at a heavy discount. Anything you want to add, Lauren?
Nope, you covered it there.
This other case study, almost identical situation. Prior lender, minimal effort with the borrower. They actually they went a little further, and this was the same lender as the prior one. They went a little further by drafting the demand letter because they had their in-house counsel, but they never sent it because the person who drafted it was trying to get approval to get it sent, but never got the approval to send the letter. And then because they were in between waiting for that, they never sent the loss mitigation package until 9 months later. So they let almost a year go by before they really started making contact with the borrower. And then when they did, the borrower said, hey, here's what I can afford. But again, back to Groundhog Day, the same thing continued to occur where they couldn't work out a deal because it kept getting tied up within the lender. So the borrower actually was offering a down payment and was making extra payments. So we bought the loan and then said, hey, can you do the same deal you offered the bank? Because for us, that worked. And it got accepted. We signed that trial payment plan. We get money up front from the borrower and then, continue to work with them. And then once they make those payments, we modify and recast that loan. And again, we'll turn around and sell it back on that secondary market. And question came up, where do we sell our seasoned loans? Other funds, other investors. Some people want to be more active in the note space. Some people might have money within an IRA or self-directed, account. They will buy them, but typically there's a lot of funds out there who are strictly just performing only, and they don't want to deal with the non-performing side, so they'll only buy performing loans and we'll look to sell to them. So someone asked about recasting a loan. So I'll give an example of one we did with a borrower in Maine that the borrower owed, I'm just going to use rough numbers, $200,000. And as part of working with them, they were getting $50,000 from the state. So there's two components to a loan. I'm sorry, let me rewind. There's your unpaid balance, which is like what interest accrues. But then if they're in default, you have all these extra fees that got tagged on. And this borrower had over $75,000 in additional fees on the loan. So if they were to pay us off, it would have been over $200,000. They were getting $50,000 from the state, but there was only 4 years left on the loan as well. So we got the $50,000 from the state, took a new payoff, and re-amortized that loan over, added 10 years to the loan to keep their payment back the same. So we extended the loan to keep the payment the same. Hope that explained it. I know sometimes I go too deep into the details. Another question, what happens if borrower fails in their trial payment plan? If they make 3 of the 4 months, it's a case-by-case basis. If it's 3 of 4, we'll probably continue the trial payment plan and just extend it for some additional time. We've had instances where they've met. We've had instances where they made 5 of 6 and we said, hey, let's give it another 3 months. And then we've had instances where they made 2 of 6 and then we proceeded to continue with the foreclosure. And in today's economic environment, most of the time those borrowers will file bankruptcy, which for us, I know a lot of people might be scared. Oh no, it's bankruptcy. Bankruptcy as a lender for us allows us to really open up and see how much debt they owe everyone, how much money they're making, and it's a structured plan by a third party that gives us our payments plus additional monies owed. So we like bankruptcy loans.
Someone asked if this recording will be sent to attendees. Yes, we will be sending the replay out, and we will also have it on our website as well later this week. Okay. So passive, obviously this is what we do. We talk about the active and passive ways to get involved. So we do have a offering. It is open to accredited and non-accredited investors. It has a 4-year term, meaning from the date you invest, there is a 4-year term. Minimum investment is $5,000, though we do offer bonus shares starting at $25,000. And the targeted return is anywhere from 8 to 10%, depending on bonus shares. So talking about bonus shares here on the next slide. So you can see starting at $25,000, essentially what happens is when you invest, you're getting shares. So at $25,000, what we're saying is we're actually going to give you bonus shares, meaning shares. If you invest $25,000, we're going to give you 100 additional bonus shares. Each share is worth $10. So it's a total of $1,000 excess. So you're actually going to accrue 8% on $26,000, even though you've only invested $25,000. And that scales up depending on the different tiers. You can see we have different bonus share levels that will increase your overall return at the end of the 4 years. Because as well, at the end of the 4 years, say you did invest that $25,000, we gave you that extra 100 in bonus shares worth $1,000. You're able to actually redeem the extra $1,000 as well. So you're getting back that $26,000. And then just some highlights about our offering. So it is open to both qualified and non-qualified accounts. So if you do have a self-directed IRA with a custodian that allows you to direct into private offerings, we do accept funds from them. We've worked with Quest, Advanta, UDirect, you name it, we've probably worked with them. Distributions are paid monthly. So it's that 8% annually paid as monthly distributions. It's not correlated to the stock market. So right now, a lot of people are, concerned about the stock market. It's, volatility. And so it is a non-correlated asset class. Like Chris and I had mentioned earlier in the slide, we talked about that equity. So we talked about how that $250,000 home, the loan is worth $100,000. We bought it for $50,000. So there is that coverage should the market drop, should the value of the home drop. It is not a blind pool. So right now we have just under 100 loans in our portfolio. So we're not raising capital. We have to hit a certain amount to deploy it. We are constantly raising capital and deploying it into our pool that is currently active. Where there are no fees. So offering expenses are paid by the sponsor. We're not going to fee you to death. Chris and I really crafted this offer intentionally based on being investors ourselves. And one thing that kind of drove us a little bit nuts was, oh, there's a management fee, an account fee, an acquisition fee, a disposition fee. So that 8% you're offering really comes down to 6%, 5%, after all the fees. And then for tax purposes, it is a 1099 dividend form, which may provide some tax alpha, but as we are not CPAs, I will make the disclaimer that you need to check with your CPA or tax professional, as they will know your unique situation and how it applies to you. We do, someone asked if we sell individual notes. We do. You can email invest@seveneyinvestments.com and we can point you in the right direction of that.
Yeah, I just want to be clear though that Lauren, I don't think you don't have a personal portfolio you're selling notes out of, or myself, because it said out, not Seveney. So the fund, yes, sells assets. Someone asked a question of a website called PaperStack. At times, yes, we may list some assets on PaperStack. We also send out assets to a diverse group of people who buy loans.
Oh, go ahead, Chris.
Okay. You usually do so well on this one, Lauren. So why invest? And we always talk about this multifaceted approach to how we manage our portfolio. And as we mentioned, we target to buy notes at a discount to the market value. And by doing that, again, it gives us that flexibility to work with the borrower in regards to those terms that we can adjust, that make sure it provides that win-win situation. We're also extremely selective. Like I mentioned, last quarter, we saw over $800 million in non-performing loans. Every quarter we're buying several million. So it's not we're not a large market share. We're a grain of sand on the size of the overall mortgage market that, again, fluctuates between 13 and 16, up to 16 trillion when you take into account one, duplexes to 4 families. We do diversify. There was a question about where do we invest? We're in, I've invested, I think overall in about 40 states. Right now, we're in between 25 and 30 states. So we're very diverse. We typically stay out of, the Northeast and the Northwest because of the foreclosure timeframes in those areas. But we're also not heavily concentrated on one city or one market. So it allows us to diversify. And then that one-on-one borrowers that we've harped upon a lot on this. And again, it's because we have in-house team of asset managers who can work on every single loan. And when we buy loans, we're doing due diligence on every single loan. It's not, here's 100 loans. Well, we hope we know we'll win on 70, we'll lose on 20, and who knows how these 10 will go. Every single loan we look at, we'll, cherry pick those that, we want to bid on to put in our portfolio. Anything else you want to add, Lauren?
No, I think you covered it. I'm trying to be cognizant of time.
Yep.
So yes, I will actually drop in the chat right now. The website, it's seveneyinvestments.com and invest@seveneyinvestments.com is the email that you'll want to email. And again, we will send out this replay. I think that's been asked a few times.
Okay. The other question about reporting, it's a 1K. We are a Regulation A+ offering, which our requirements are to submit a 1K on an annual basis. Do you want to take why this fund, Lauren?
Yeah, so kind of, again, trying to be cognizant of time. Thank you guys so much for joining us. But why this fund? So, it comes back to that passive versus the active. It's that cash flow without the headache of managing everything that goes into mortgage notes. While it may seem, and I think I got into it thinking it was a lot more passive than it was, what I realized is it is more active. So when you're investing in a fund, you're essentially doing your due diligence on Chris, myself, the fund, the structure, what it looks like. And then investing, and you're sitting back and collecting those distribution payments. Profitability and varying market conditions. So like we mentioned, in a downturn market, when there is more inventory, our profits increase as note prices decrease, which allows us more flexibility to work with the borrowers and creating those repayment plans and structuring those win-win solutions. We have that collateral and equity. So our investments have up to 3 times equity coverage, which protects the investors and the investments in a downturn market. So should those housing prices drop? And then versatility and diversification. So when you invest in a single note, you're really tied to the outcome of that specific note. When you're investing in a fund, you're tied to the outcome of the entire portfolio. So you do have less risk. It's spread out among all the assets. And then within that, there's also the numerous exit strategies we can take within, with a single note. It's not, we have to do this. We can be creative. We can work with the borrower in a variety of different ways. So.
The other thing I'll just mention about, again, that versatility and diversification is you're not tied to one asset. You as an investor aren't tied to a single note or, other types of syndications where it's tied to one single asset. You're investing in a pool, and it's not a blind pool. We have, we've had up to 150 notes within the fund. So we already have the assets within that offering. And, again, as our experience, as we mentioned, we've done 600 plus deals. We've been in 40 plus states. This isn't our first rodeo, and we've managed 5 prior full cycle offerings. And someone asked a question about why is it 4 years? And that is looking at our prior offerings, really the best time period for the cycle of a non-performing loan, or several cycles of non-performing loans, which can take up to 2 years to get cycles of the offering to give us that 4-year time period. So it was something that is from a lot of experience that we've had in the past to make sure we optimize the offering for investors. And then, as we mentioned, our vertically integrated team, and to date, we have never missed a distribution.
So I think that someone had asked for the email. You can see the third bullet point here is invest@seveneyinvestments.com. Feel free to reach out with any questions. If you want to hop on a call with one of our team members, they'd be happy to do that. And they can send you a link to schedule a time that works best for you. If you're not on our newsletter, we do send out deals of the week. So you'll be able to see kind of examples of what we do week over week. And again, any questions, or if you do, I think I mentioned earlier the due diligence webinar. If that is something you're interested in seeing, please email that email, let them know, just send them, say, hey, I'd like to see the due diligence webinar, and we can send that over to you to watch at your leisure. So thank you again so much for joining us. We are at the top of the hour, so I do want to give you your time back and be respectful of that. But again, feel free to reach out with any questions, to schedule a call, and we hope to see you next time. Thanks, everyone.